Welcome back to another video. Today I'll be talking about whether Fair Isaac stock is a buy in today's market. So for reference, this is my portfolio. I don't currently own the stock yet, but the stock is piquing my interest because the stock is down around 50% since the all-time highs. So for Fair Isaac as compared to your S&P 500, your S&P 500 is up around 10% year to date, whereas Fair Isaac is down around 30% year to date. So Fair Isaac is underperforming the S&P 500 by around 40%, and it is currently trading at a 51 times earnings, right at its 52-week low. So for Fair Isaac, this is their business model. So when a consumer needs a loan, when a consumer needs a car loan, a housing loan, or just some credit loan, what they will do is they will go up to a bank. And then what your bank will have to do is to assess the consumer. So they will go to your credit bureau to ask for a report. And then for your credit bureau, what they will do is they will go to Fair Isaac and then ask to generate the score. And then Fair Isaac will use their algorithm to generate a score, and then they'll pass it back to your credit bureau, which will pass it back to your bank. And then from then, your bank will be able to assess what interest rate to put for the loan, how credit worthy the consumer is, and then they will lend the money to the consumer. And then after that, what your bank will do is they will wrap up the entire loan, and then they will sell it to your government-sponsored enterprises, including Fannie Mae and Freddie Mac. And then Fannie Mae and Freddie Mac, what they will do is they will package them up as mortgage-backed securities, and then they will sell it to investors worldwide. And this is how the entire system flows. So without Fair Isaac, liquidity cannot flow. So imagine if Fair Isaac isn't there to standardize the scoring, it will make the entire system here extremely hard, which was what happened before 1989, before the credit scores actually came out. So before 1989, there wasn't a standard score for everything, and that slowed down this entire process here. So your banks couldn't assess the credit worthiness of the consumer, so they can't really lend money out. And as soon as FICO came out with this score, the entire system here became standardized. So for FICO, this is the moat of the company. The company's moat is simply just its ability to generate better scores than VantageScore. And for FICO, it is used in more than 90% of your mortgage lendings in the US. And this is what the CEO actually came out and said as well. So he said that the company is not seeing any market share loss. Although VantageScore is widely used, VantageScore is simply provided as a free service by all the different banks because VantageScore is extremely cheap. But FICO score is what is used when it comes to the decision-making process. So Vantage is used sort of like a screener, whereas FICO score is the actual one that is used for confirmation of debt and confirmation of the lending out from your banks itself. So for FICO as compared to VantageScore, FICO is actually a lot more accurate as compared to your VantageScore, and besides that, because FICO score has the brand attached to it as well, it is much easier to obtain a loan if you attach a FICO score to your credit report. So this is what FICO came out with. They said that based on enhanced prediction, use of FICO 10T rather than Vantage 4.0 by market participants throughout the mortgage industry will drive significantly higher loan approvals for prospective borrowers, and due to better model performance for mortgage insurers, investors, and others, improve mortgage pricing and lower costs for borrowers, benefiting millions of Americans. So what they're saying here is true as well. It is similar to S&P Global and Moody's. So for S&P Global and Moody's, the reason why people cannot switch from them is because of the brand attached to those two companies. So if let's say a company wants to get debt, the company wants to sell their debt, they will have to go to S&P Global as well as Moody's so that they can get the lowest possible interest rate. If another company comes by and offers ratings, it still doesn't make any economic sense for the company to get it rated by this new company because they have to pay a much higher interest rate on the loan that they're trying to get. So it is similar to your FICO here. If your credit reports are tied to FICO scores, then your loan and your interest rate payments are actually a lot lower as compared to the Vantage score. And based on what Dev Kantasari has said, it is between 0 and 1%. So besides that, FICO is actually extending their moat as well. So similar to what Apple does with their phones almost every single year, FICO is also expanding the number of scores in each industry so that they can tap on as many different industries as possible. So you have FICO score in auto loan, you have FICO score used for credit card applications, you have FICO score used for mortgage applications and for all these different products as well. So they have multiple lines as well, like your FICO XD and so on. And what they're trying to do is to extend the network effect so that FICO becomes even more dominant than it is today. So for FICO, if you have to look at the pricing power of the company has increased prices massively. I mean, if you have to look at the past 7 years, the company is actually around 9x their prices. So the company is expected to grow its pricing by around 20% for the next few years at least. And when you have a company that is able to increase prices by 20%, the net income will actually grow a lot faster than that. And given that around 80% of FICO's net income actually comes from this score portion, that will be a lot of net income growth for the company in the years ahead if they can continually increase prices at this sort of rate. So besides that, your mortgage market in the US is depressed right now. So ever since the rate hikes came in, your mortgage market is actually stagnating and is depressed in the US. And as soon as we see a recovery in that portion, we could see volume increase in terms of the FICO scores as well, which could be bullish for the company on top of the price increases that the company is going to implement. So for FICO, this is the worst case scenario. So 80% of their net income actually comes from scores. 2/3 of that is from the B2B portion. So they have the B2B scores, which is to the credit bureaus, and they have the B2C portion, which is direct to consumer. 2/3 of the net income from scores is actually B2B, so it's to your credit bureaus, and 1/3 of that B2B portion is mortgage linked, which is directly related to Fannie Mae as well as Freddie Mac. So if the company loses a 20% market share, let's say hypothetically, the company loses 20% market share in that segment, that will be a 3% hit in net income for FICO, without accounting for price increases. So I think the reaction so far is over-exaggerated. The company is a high quality one, and I don't think it will be affected by this change in your mortgage lending system. It will have minimal effect on the fundamentals of the company, and it is likely re-rating because it was trading at too high a valuation before the event happened. So for FICO, these are the metrics for the company. I mean, if you were to look at the gross income, the net income, the profit margins as well, the company has steadily increased it over time. And if they can continue increasing the prices of their scores, the margins will go a lot higher than what it is today. And besides that, the company has stellar returns on capital employed, as well as ROIC. I don't think you'll be able to find another company that has similar metrics to this. I mean, the return profile from this company is just incredible. So let's say the worst case scenario, FICO gets regulated with a maximum annual price increase of around 5%. So a 5% increase in prices will lead to around a 6 to 7% increase in terms of the net income, counting that your fixed costs remain the same. So that would be around 6 to 7% net income growth, and with buybacks and with volume increases as well, the company could easily get between a 10 and 15% net income growth if all this portion stays stable. This is similar to another company which is VeriSign. So VeriSign has their prices capped for the first 2 years, and they can increase the prices by 7% for the last 4 years in their contract with the icon. That would average out to around 5% increase in prices every single year, which is what could be possible for FICO as well. So for FICO, this is probably the worst case scenario for the company. And for FICO's valuation today, the company is pricing in around a 15.5% free cash flow growth from year 1 to year 10. So of course, the company is still not extremely cheap today, but I think at its current valuation, it is probably around fair value. I'll be looking into this one even more. I think the company is a high quality one, just probably a smidge too expensive. So we have to see how this one plays out. A quick plug as well, if you guys don't have a broker yet, then you may want to consider Moomoo. Moomoo is giving out this exclusive rewards to viewers on this channel. So you'll be getting $20 worth of Nvidia shares if you sign up with my link there and deposit $100 in your new account. This is an affiliate link, so I'll be making a small commission out of it. So if you have someone else providing the link, then feel free to use that one as well. If you're interested, feel free to sign up today. The next portion, I'll be talking about the markets at all-time highs right now. So the CPI report actually came out, and your CPI came in at 2.7% as compared to 2.8% that was forecasted. Your core CPI came in at 3.1% as compared to 3% that was forecasted. And overall, this showed that your tariffs had no material impact on the inflation in the US itself. And that's why you're seeing the S&P 500 at all-time highs. I mean, the markets are now above 6,400 points. So the markets are at all-time highs now, but is the valuation sound? The market's trailing PE is currently at around 28 times. So from a historical perspective, the company's P ratio is of course elevated. The markets are probably expensive today, and so if you're looking for value, it might be hard for you to find them. But of course, there are laggards in the market today as well. And I'll be highlighting 2 stocks over here. One of them is United Health, of course. United Health is down around 50% year to date. It is currently trading at an 11 times earnings. On a forward PE basis, the company is trading at a 15 times earnings. For United Health, I think the company is massively undervalued. I mean, if you were to do a discounted cash flow analysis of the company is pricing in 0 free cash flow growth for the next 10 years. So I don't think United Health is expensive today. I think it is a company that is extremely cheap, and one that has a margin of safety that is attached to it as well. As for the other company that I'll be covering as well, it is Otis. So Otis is a Lyft company. They have majority of their net income coming in from the services portion. So what Otis does is similar to what ASML does. Otis is operating in your Lyft segment. So they build the lifts and then they sign contractual agreements with all these different companies to maintain the lifts for them. And then they increase their prices by mid-single digit every single year. So for Otis, it is a quality business with recurring streams of revenue coming into the business almost every single year. The company is not fast growing and that's why I haven't bought into it. But if the stock continues falling, then this could be one that is interesting as well. The last portion, I'll be covering some questions left in the comments. So the first one, it says, what's your thoughts on Ethereum treasury stocks like Bitmine, BMNR, SharpLink, and SBET? So for me, I don't like crypto. I view them as speculative assets. So for all these Ethereum linked stocks, I'll be avoiding them completely. I won't be buying into them, although Ethereum has gone up by quite a fair bit over the past 2 months. I've seen people online flipping on it, and this is probably a telltale sign that it is getting a bit too speculative. So for all these different stocks here, I'll be avoiding them. But for me, I'd rather invest in quality assets that can generate free cash flow every single year. The next question it says, hello Juan, what is your take on Intuit that go down around 5%? So Intuit is a quality business in your software space, but for Intuit, I think the company is still a bit expensive today. The company is trading at a 57 times earnings, and although the company is high quality, although the company is growing rapidly, although the company is mission critical, I think the company's share price today is a bit elevated, and AI could be disruptive for all your different software companies, which will lead to more re-rating in the future. I hope you guys have found this one useful and invest